Welcome to the What to Watch video update. Every week I do a number of different videos. Well, the last video I do each weekend is I go through all the charts and I pick out those that seem to be really telling us something right now. And then I put them into three categories. Those charts that are looking positive, those that are looking negative, and then those things that we're just watching because they can have an impact on what is actually happening in the stock market. We're asking the question this week, has the S&P 500 bottomed? And this is being prepared for Monday, April 14th. First, we look at the positive charts. Now, since we had an up week, we look at the intraday chart and it's on the positive side. We were up over 5%, which normally would be a really good return for the week, really powerful. And it helped some of our charts, but it hasn't turned things back over to positive yet. When we open on Monday, you can see there's a real tug of war going back and forth. We go up, we go down, we go sideways, and these are pretty big percentage moves. Then on Tuesday, we gapped higher and then spent the rest of the day coming down. So that was rather discouraging. Then Wednesday was that massive up day that we had. And this was just a short cover rally that got out of hand. It really didn't see an awful lot of buying enthusiasm. We were chopping around right after the open. We started to drift higher. And then once we got above the daily pivot, we just shot up. And this is when folks who are short the market, they're in trouble at this point because they sell to get in, hoping to buy back at a lower price. That's how they make their profit. Well, just the opposite was happening. They sold to get in, and price starts going up, and they have to buy back the shares because there's greater financial requirements and there's theoretically anyway unlimited risk. And so you might see that where a market's just going up and up and up out of control. That's called a short squeeze or short covering because those people that are short, they can't just sit back and wait and see how things are going to play out. They actually have to do something. And so that just keeps pushing prices up. And that's when we had that really big up day. Well, then it looked like, okay, we're going to give back those gains because we gapped lower on Thursday. And we did really start to come down. But then we were able to recover from that and close well off of the lows. Then on Friday, we were pretty much flat. And these are big percentage moves. It doesn't look like it. The market's been really volatile here. And then we broke to the upside, and you can see we closed at the high, but things really tapered off. This was a real exhausting week for people that are involved in the markets, and they probably just got tired and said, okay, looks like we're going to finish positive here. I just want to get out of here and go enjoy the weekend. And so it ended up being a positive week off of the highs that were set on Wednesday, but still ended up being a nice little bounce. Okay, then one thing that is interesting though is that we've been just way above average with volume. And then Friday was also above average. It's green here, but it really dropped off from the heavier volume that we saw earlier in the week. This is improving, but still not looking all that positive. This is an intraday chart of large cap growth, which is in blue, and large cap value, which is in red. And in a more positive environment, we want to see the blue line above the red line, even though they're on different scales. You can look back over the recent past, and when the blue line is above the red line, we're typically going up. When the blue line's below the red line, we're typically going down. Well, both growth and value have been getting hit lately, along with everything else. With the upward move that we saw going into Friday, especially, this is showing an improvement with no real advantage right now. What we want to see is the blue line outperforming the red line, and it is improving, but that's why I have it on the positive side, but we still need to see more follow through. We're seeing a similar thing here with S&P growth to value intraday. This is coming up looking nice, but we need to see more follow through. We've been kind of flat here over the last few sessions. If this can continue to go up, that would be more positive for the S&P. If it goes down, naturally, that is when it's more negative. I have three smart money indicators that I look at, and I call them smart money because they not only take price into account, but volume into account. The first one here is called accumulation distribution. and we're above the red line. And so that's the line in the sand between positive and negative. We actually crossed below the red line, but then we were able to get back above it. So we are positive here. The second smart money indicator is called the Chaiken Money Flow, and mainly I follow the red line. When it's going up, that's positive, and you can see the histogram has been improving here. So smart money indicator number two is positive, and then the Chaiken Oscillator, it was giving us an extreme negative reading, and to this point, we've been able to bounce up above that, and there's a moving average here that's a little hard to see, and we're above that. So all three of our smart money indicators are positive. Swollen trading oscillator. It had been quite negative there for some time, but now it's starting to turn back up. We're still below zero based on price and volume, but we are going up. So this chart is positive now. And we had an extreme negative reading with the bullish percent index. This measures the point and figure buyer sell signals inside of the S&P, and it had become quite negative. Other times, this showed some kind of a bottom in the market. Well, we're coming up and we crossed back above the moving average. So even though we're well below 50 and we're still extreme negative, we are above the moving average. So this is being counted as positive. Then we're all over the place with point and figure charts. When you see X's drawn in here, that's positive. That means prices are going up. When we see O's, that means they're selling. Prices are going down. And this doesn't take time into account. It's just how much of a move is actually taking place. Well, anytime we see X's in here, that's positive. So this chart is showing some improvement after showing an awful lot of O's as we've been going down. Another long-term support level that is still holding is a 50% Fibonacci retracement level when you measure from the October 2022 lows up to the February 2025 highs. We gave half of that back and we came right down to this level and we're able to bounce up off of that. And so that's very long-term support that is holding for right now. And that's considered as positive. And we were able to get back above this 38.2% retracement level as well. So this is showing some improvement. Long term, we have a weekly chart here of the S&P with a trend line going all the way back to the 1987 crash. It's a little hard to see here, but we're just barely back above the trend line now. To make it a little easier to see, this is that same trend line, but only going back to 2019. We came right back up to this trend line. So we were able to recapture this long-term support as well. Another way to measure this is we go from the October 2022 low to the October 2023 low and then extend that trend line forward. We came right down to this level, and so far we've been able to maintain price above that trend line. So another example of long-term support that's holding. Then we have pivot points too. Now it was more negative when we dropped below this P, which is the pivot itself. We came all the way down to S1 and closed right at this point. We fell below it, but then we were able to get back above this S1 level. So this S1 level is also long-term support that's holding for right now. It'll be even more positive if we can get back up to this pivot point here and actually go above that. It held for support for a while, but then finally broke down. So we'll see if that can show some improvement. But this other area of long-term support is holding for the time being. Then there's a trend channel going from 2009 up to Friday's close. We started to fall down below the midpoint. Now we've fallen below it before, but then we were able to recover here. We did fall a little bit below this midpoint, and now we're back above the midpoint. So another example of long-term support that's holding. Then we look at a ratio between the NASDAQ 100, which is growth, and the Dow, which is considered to be the best of the best, the highest value stocks. And there are value stocks in there, but there's also growth stocks in the Dow. We're still right around this red line. If you notice, we went to the dot-com boom and then bust, and then it took us many years. This is the end of 2021 before we went into the bear market. Well, we're not really seeing this ratio breaking down this time. So this is being taken as positive. And we look at the QQQs, which is the NASDAQ 100, to the IWM. Those are the small caps. And it's not that the QQQs are doing well, it's that the small caps are doing bad. And that's causing this ratio to go up above this blue line. And so this ratio is still holding up. Now we look at the negative side, and still, even with the bounce that we saw this past week, the negative slides are more than what we saw on the positive side here. Now we're negative on the daily chart just because we're coming down. And one thing that we're really watching for here is the blue line, which is the 50 period moving average. It's getting close to crossing below the red line. That's what we call a death cross. When we cross positive, it's called a golden cross. It's the 50 and the 200-day moving averages. Unless we have a massive bounce from here, to negate a negative crossover, this is going to turn into a negative trend. Now, we could get that back, but these usually don't happen very often, these crossovers. And this is when a lot of folks make their decision. I use this. This is the foundation of my long-term portfolio. When the blue line crosses above the red line, I go long. When the red line or when the blue line crosses below the red line, that's when you either get out or get into bearish types of positions. But I also implement lots of hedging at the same time. And I teach that in the program that I have, which there's a link to that right below this video. So we're just keeping an eye on this because a lot of people are going to change their attitude if this blue line falls below the red line. Now, this has already happened. Excuse me. This has already happened with the small caps, the mid caps, and the Nasdaq. And we're seeing it in some other areas as well. The S&P is holding up right now because it's a balance of growth and value, and it's the benchmark of the US stock market. The Dow's still holding up for right now, too. But if these cross over negative, that's going to switch the way a lot of people manage things. All right, and we're looking at sentiment, which is still quite negative. We're well below 25, and other than a little peak above it here recently, we've been well below this 25 level and just camped at this point. And until we get some kind of a sustainable bounce up out of this, and we see that the context is actually crossing back above 25, this is still considered negative. Usually we just come down here and V bounce out of this. Well, that's not what's happening now. People are coming down. They're extremely pessimistic about the market. There's a lot of fear in the market, and they've just been staying in that area instead of it being some kind of a washout that we move up out of. Now, we could move up out of this at any time and change this over to positive, but for right now, it continues to be negative. And then we look at the VIX. Now, we get concerned when the VIX goes above 20. Then it went above 30, then 40, then 50. Okay. Now it's back down. It's still giving us a very, very high reading at 37, but it has dropped a little bit to under 40. And on this chart, the line, that's the closing value. And then the bar, this is the open, high, low, close. You can see the really high readings. We got up to a reading of 60 on an intraday basis here before starting to come back down. Now, this could go back up, but as long as this continues to decline, that could be more positive. But just the reading in and of itself shows that there's a lot of fear in the market. We look at a number of growth to value ratios, actually looking a little better here with small cap growth to value, but we're still negative overall. We spent a long time underneath the 200-day moving average. Now we're hanging on to an uptrend, but unless we see some real power coming out of this, we could see a death cross pretty soon. Not as strong here with the mid caps. We were able to get back above the 200-day moving average with this ratio, but we're still below the 50. This is the one that's concerning me the most because it has to do with the S&P 500. This is the growth to value ratio, and we're just starting to see a death cross here. And that means that the large caps and the growth stocks, the Microsofts, the Google, the Apple, the Nvidia, they're underperforming the rest of the S&P, and value is actually outperforming. And that's what the market does when it's starting to turn more defensive. And so this coming down and actually going into a downtrend is more negative. Now we look at a growth to value ETF, well below the rainbow, trying to bounce back up here, but still looking negative overall. And we look at a number of different growth to value ratios. The Qs, which is growth, to the S&P, which is growth and value, showing a little bit of improvement, but the moving average is still pretty much declining here. We're chopping sideways with discretionary to the S&P, which is, you can take it either way. That's positive because the moving average is smoothing out, but we're not showing any real conviction to the upside either. And we are above the moving average here, but it's still declining for the most part when we look at large cap growth versus large cap value. And then we look at the large caps, which is showing some improvement. The mid caps back above the moving average, and small caps are actually looking a little bit better. So some of these charts you could interpret as being positive, but we need to see follow through, and we need to see these moving averages turn and decisively start to go higher. We look at a ratio between high beta stocks, and these are stocks like Apple, Amazon, Netflix, Google, Nvidia. They outperform the market when we're going up. Unfortunately, they outperform the market when we're going down, meaning they go down faster. And so we do a ratio between the high flying stocks here and then the more conservative stocks that tend to maybe not go up as quick when we're going up, but they don't go down as quick when we're going down. And we look at the ratio between them. And as prices have been falling, this ratio has been going down, meaning the high beta stocks are underperforming the low beta stocks. We came down to a very low reading here, and we are trying to bounce, but we need to see more of a sustained up move. So the context of this overall is that it's still negative. We look at another ratio between discretionary to staples. Discretionary, that includes Tesla, Amazon, things that make life fun. Staples, that's toilet paper and toothpaste. And staples tend to do better when the market's becoming more defensive. And we're seeing this ratio really coming down below its 200-day moving average. We're still in an uptrend, but that uptrend is starting to go away when we look at this ratio. And then for the seventh week in a row now, individual investors have been extremely negative about the market. Usually what happens is we're going down and they all freak out, and that includes anybody listening to this video, because you're an individual investor most likely. Usually we V bounce out of this. We come down, everybody freaks out, they sell and becomes front page news, and then we move up out of that and the market starts to recover. Well, this time they've come down and they've just sat there, similar to what we're seeing with sentiment. They're extreme negative and just staying extreme negative, and that's how individual investors are feeling currently. And we want to keep an eye on this. Since we've been going down, if we fall over 10% on a closing basis from the all-time high, that means that we're in a correction. Now, if we go down over 20% from the all-time high, that's the definition of a bear market. And we got close, but we're now 12.71% below the all-time high that was set back in the middle of February. If we can keep going up, this number would continue to go down. We would go below this dashed line, which is the 10% level, and things might have a shot at turning back more positive. But for right now, since we're above the 10% level, this is treated as negative. And the condition of the short-term trend, I use a double and triple exponential moving average to measure that. And we look for the lines to either be going up or down. We're kind of chopping sideways right now, trying to improve, possibly coming into a bottom, but we haven't actually turned over positive yet with this chart. And we're still quite, excuse me, sorry about that. You got to love these take one videos. We are still negative when we look at the condition of the intermediate term trend that I use. It's based on 50 periods. We are trying to improve, but the blue line and the red line continue to go down. And we're below the 200-day moving average. Right now, we're 6.79% below the 200-day moving average. We were a lot worse. We are improving, but the fact that we're below it, that's treating this chart as negative. And just you can see up here where we're seeing the 50-period moving average coming down close to the 200-day moving average. And we're getting a bit of a mixed picture here, and so I'm treating this more as negative. We're still above the moving average when we look at the advanced decline line based on price, so that's why it's green. But we're below the moving average when we look at this based on volume. So mixed picture in this case means we default to the negative side. Then we look at the 10-day advancers minus decliners. We came down right to this green line here, and we've been able to bounce up off of that. Now it's improving, but it's negative because we're still below zero. And we look at the new highs, new lows. We've been getting just a massive number of new lows, really extreme, but it is improving a little bit here. But we have a 5-day moving average and a 10-day moving average of what's happening between the green and the red here, and they are still declining. So they're improving, but still negative. Then we look at the short-term trend, And this is using the ADX, the average directional movement. It's rolling over a little bit here, but the reading is above 40, and that's when it's extreme. And then we determine the direction by which line is on top, the red line or the green line. Well, even though the red line is declining, it's still above the green line. If we improve and the green line crosses above the red line, then that would turn the trend positive. But this could be a weakening trend here in the short term if we drop down below this moving average. Just doesn't mean the trend's going away. It just means it might be slowing down. This is the one that I focus on the most. This is the same chart, but instead of the short term, it's looking at the intermediate term. And we are rolling over, but we're still above the moving average. We're still negative because the red line is above the green line, but it could be improving because the red line is really coming down. And this is a weekly chart of that same thing, where we do have an established trend here. We're above the moving average, we're above 20, and it's negative because the red line is quite a bit above the green line here. And then we look at a rate of change. We go with Friday's close and we go back 50 trading days and compare the difference between the two. Now, the short-term rate of change charts that I look at, those are improving. This is intermediate term since it's based on 50 periods. And even though we're improving, we're still below this pink line, which is at the minus 10. We need this to continue to go up to show that there's more improvement. Then the vortex, this is pretty easy to interpret. The red line is above the green line, that's negative. If the green line was above the red line, this would be positive. And then we look at the McClellan oscillator, which is improving after getting extreme negative here, but it's still below zero, so it's negative. And when that's negative, we're going down with the summation index based on price, and we continue to decline based on volume. Parabolic SAR, if the dots are on top, it's negative, and that's what we're seeing here currently. We're also seeing that on the weekly chart with the dots on top. Momentum is negative. Now we're seeing a little bit of an improvement. I have two short-term oscillators here. One is called the TSI. It's actually turning positive, crossing back above its moving average. But the other short-term oscillator, the slope oscillator, it's still going down. We are improving with our three intermediate-term oscillators, but we're still below the moving average. And we're still negative with the TRIX and the KST, which are two long-term oscillators. And another oscillator is the Koppik curve, which continues to be negative. In fact, it might even be extreme negative. We're below the moving average and declining. And you can see when you compare this with other readings, we're kind of in that range where we tend to be extreme negative. We're below all the moving averages here. And I plot both a simple and exponential moving average of the 20, 50, and 200 period moving averages. And we're below all of them. And the more we stay below them, the more we see this waterfall look as the other moving averages are coming down. So until we can recapture some of these moving averages, this is treated as negative. And then we measure how far away are we from various moving averages. We're still kind of far away from the 20 period moving averages. And this is called a boom indicator because we get too far away and then we have a tendency to boom, go back to the moving average. And we're also far away from the 50 period moving average here. So that could actually end up being positive since we're below these moving averages. But until that happens, this is treated as negative. And then we look inside the S&P and the number of stocks that are above their 20 period moving average on a percentage basis. We had a really extreme negative reading. We got down to 2.5%. That means 2.5% of the stocks in the S&P, all the other ones are below their 20 period moving average. And this can be used like an oscillator. We get to an extreme negative reading. We're coming up and we're just starting to go above this extreme negative territory. We look at those stocks above their 50 period moving average, also showing some improvement, but still negative. Above the 100 period moving average, improving. And the line here is if we're above or below 50, and we're still well below 50. And we're even showing some improvement here with the 200 period moving average, but they're still, these charts are still seen as negative. Then this is a long-term oscillator called a special K, and we crossed below back in March. So that's turning the long-term trend based on this chart to negative. We are still positive on the weekly chart, but we're really coming down and we could see a crossover negative unless things really improve. Then here is the weekly version of the point and figure chart where we're seeing lots of O's. We saw some X's on the daily side. We're still seeing lots of O's here, even though we closed up well off of that. This is a descending triple, I have to move this bar, triple bottom breakdown. And this longer term is just showing that the weakness is still there. We're also looking at a ratio between the SPY, which is the ETF for the S&P 500, and staples, which is toilet paper and toothpaste, the things that people have to have. Now, right at the end of 2021, we saw a breakdown of this ratio. It really started to roll over. Now, if you remember back, we set the all-time high with the S&P in 2022. So this was falling apart starting in late 2021. So this can give us a bit of a heads up. We're seeing a very similar thing happening now. We don't know for sure. Only hindsight will tell us if we're actually right. But we're concerned about this because we hit the high with this ratio back in January. The last high that we set with the S&P was in February. And then since that time, this ratio has been really deteriorating. It's trying to improve right now, but we need to see some more strength coming from this, or we're seeing a very similar picture to what we saw before 2022, which ended up being a cyclical bear market. We are negative here with all of our different advanced decline line studies. We're below the moving average with the NYSE common stock, the S&P, the mid caps, and the small caps. And the Dow is negative because it's below its 200-day moving average. It's coming back up to this S1 pivot point, which is acting as overhead resistance. It still has a little further to go to see a death cross here, but we're keeping an eye on that. And the longer we stay below these lines, the more we might see that death cross. The Nasdaq has now generated a death cross where the 50-period moving average is now crossed below the 200-period moving average. The Nasdaq 100 right there. And unless we get a massive upward move, we're probably going to see a death cross here. And this is growth, and these are the high-flying stocks. Nasdaq 100 momentum is improving, but we're still below the moving average, so it's treated as negative. Small caps, recent death cross, just not looking very strong right now. The other small cap index, the Russell 2000, also recent death cross. We're trying to improve with the RSI, but the momentum continues to be negative. Mid caps, also recent death cross and not looking very solid currently. And the micro caps, we've seen a death cross here and falling down and just not holding up very well. This is another one we're concerned about, the Wilshire 5000, starting to generate a death cross here because we're below both of the moving averages. Then another broad market measure, the total US stock ETF, still hanging on. We still have a little bit of room here, but the longer we stay below both these lines, the more we're likely to see a death cross at a broad market measure like this one. The financial sector, now it's negative because we're still below the 200-day moving average, but the trend is hanging in there. And they had a good day on Friday, and we need the financial sector to do better. And we saw some of the banks reporting last week. There'll be other reports coming out in the upcoming week. But if we could get back above the 200-day moving average, that would improve things. And even if we could get back above the 50-day moving average, that would turn the trend back up and show it getting stronger. But for right now, it's negative since we're below the 200-day moving average. And semiconductors, this is discouraging because they're in a downtrend, recent death cross. And I have a number of different semiconductor charts. We look at indexes, we look at ETFs, we look at the SOX index. They're all negative now. And that's a huge part of tech. So the fact that these are negative is not very encouraging. It was really the semiconductors that led us out of the bottom back in 2022. They finally crossed positive in early 2023, and we've been riding that uptrend ever since. Now it's starting to get under pressure. And we look at a weekly chart of the NASDAQ 100. We're below this trend line going back to 2009. That's negative. And we look at a ratio between the semiconductors, which is growth, and the Dow, which is value. This continues to go down with this ratio, and that's negative. Then we look at a ratio between stocks to bonds. And in a general sense, if we're going up and the rainbow's going up here, that means the market thinks there'll be a soft landing, meaning no recession. Well, that's really in doubt right now. And so we've been dropping below this rainbow, thinking that there'll be a hard landing or a recession may develop. So that's treated as negative. And we're starting to see where bonds are outperforming stocks. This is an inverse of that chart I just showed you, but we get a little different perspective this way. Where bonds had been really underperforming, now they're starting to outperform, and we're seeing a recent golden cross with this ratio. Home construction, it was one of the first areas to really start to buckle. In late 2024, it's been really coming down. The rainbow is really coming down, and this is negative. And unless we see some real improvement here, this was kind of an early warning sign to us that things were turning more negative. Then the areas that we're watching, we just want to keep an eye on weekly jobless claims. So far, this has been holding up for the most part. This is really going to break down before we're likely to go into a recession. Right now, everything's looking okay. We just want to keep an eye on this. And we also want to keep an eye on continuing claims, folks that are unemployed for longer. We've been pretty much going sideways here in 2025, so we're not really seeing any big changes. We'll be watching this week after week to see, are we still going down sideways, or are we starting to go up? And this plots everything together. The red line are the initial claims, the blue line are continuing claims, and then we have the unemployment rate also plotted on here. And then we look at a weekly chart just to keep tabs on what's happening here. We have the S&P on top and then the German DAX. It's the biggest stock market in the EU. And it had just been screaming to the upside as the S&P was really coming down. Well, now we're seeing them kind of switch. In fact, they were actually having a tendency to have an opposite correlation, meaning if one was going up, the other one was going down. They've worked that back to neutral as German stocks, everything got hit over the past couple of weeks. And so we're seeing just a little bit of a shift back. Instead of going in opposite directions, they're having more of a tendency to go in the same direction again, but the correlation is still neutral, but possibly getting stronger. And then we're just watching this. This is the mass index. And the idea behind this is we cross above the red dashed line, then we go above the blue line. The signal is triggered when we come back down below the red dashed line. And the mass index says, okay, whatever happened to cause these signals, which in this case we were going down, once the criteria is met, this suggests that there'll be a reversal. Well, we haven't really seen that yet. We've seen things improving, but not an all-out reversal. Well, now we're possibly at the point where we're getting another signal. We're above the dashed line. We're above the blue line. If we come back down to the red dashed line, we'll be looking at the context. Is it because the market's going up or the market's going down? Now, these sometimes give good signals. Other times, the signals are not even worth looking at. But we don't use decisions just based on this chart. We combine it with other charts to reach a consensus. And we want to keep an eye on bonds because the 10-year yield had really been coming down. That was seen as a flight to safety. Folks were getting out of stocks and getting into bonds. Well, over the last week, interest rates rose 0.5% in a week, and that's a big move. And we want to keep watch the signs that are happening here. We don't really know why this is happening. There's speculation. It could be that China is selling some of their bonds because they own 700-800 billion dollars of U.S. bonds. And this could be a way that they're trying to get back at us by selling our bonds, which drives interest rates up. That drives mortgage rates up. That drives the cost of borrowing up, and that could really hurt the U.S. economy. So this going up is a concern. And if it keeps going up, eventually the market's going to really not like that. And we want to watch the relationship between cash and 3 to 7 year bonds. Now, when I did this video a week ago, we're seeing just the opposite right now, at least with some of our charts. When this ratio is going up, that means there's uncertainty about inflation and interest rates. Well, we've been really dropping. That means the market's not really concerned about inflation or interest rates. Well, that all switched as we're going back up now. So we'll watch to see how this plays out. If this ratio goes down, that would be more positive for stocks. If this continues to go up, that's likely more negative for stocks. And we use that same basic approach here, but we're not seeing as big of a switch. We use TIPS, which are Treasury Inflation Protected Securities. These are instruments that folks get into when they're worried about interest rates going up because these adjust or they're worried about inflation increasing. When folks feel that we've topped out with interest rates and we're starting to come down, that's when they jump over and use 3 to 7 year bonds. And that's really what we've been seeing here. It's really been coming down. So this is suggesting that the market's not really worried about inflation or interest rates. But this has been volatile with everything else over the last week. So we'll have to see if this changes. But for right now, this is still looking okay. We use that same basic method to look at tips to 7 to 10 year bonds further out. Also, down here near the low end of this ratio, it had been really dropping, which means the market's not really concerned about interest rates or inflation. No matter how much people talk about it, it's still under control. But if this really starts to go back up, that means that fear is coming back in about inflation in particular. We want to keep an eye on the 10 to the 2 year yield curve, even though it's above this blue line. That means that it's normal. It's not inverted. And that hasn't been a problem. It finally went back in 2024 and actually went back to being normal again. Where this is a concern is we look at it in context with the next chart, the 10 to the 3 month. It has recently gone back to being inverted and now went back above this red area and is no longer inverted. This is when we start to say, okay, now that they're no longer inverted, we begin a countdown to see, are we going to go into a recession? Now, we're not getting that signal from the 10 to the 2, but we're getting this signal again from the 10 to the 3 month. So we'll just keep an eye on things. And there's no real hard and fast rule saying, okay, 83 and a half days after this happens, we're going to be in a recession. No, we just have to look at the other charts and see what is the general trend that we could be heading into a recession. That's why this is in the watching area. Want to keep an eye on oil, which is not inflationary. It's actually been going down and we're getting into the low 60s. For a while, we actually dropped into the 50s. And then the dollar's just been getting hammered. And is this another trick? Is China going in there and actually trying to devalue the dollar by selling it? We don't know if that's what's actually happening. We might find out, but it'll be way down the road. And we need to know what's going on right now. But the dollar, after being strong, this is when all the tariff talk was coming in. And you would think with the tariffs kicking in, that usually puts more value into a country's currency. Well, now it's starting to come down, and we're not quite at a downtrend yet. The big takeaway here is that we've dropped below 100. Now, we also dropped below 100 back in 2023 and then bounced up out of that. Are we going to hit some kind of a level here and be able to bounce up here? We don't know that yet. Now, the stock market likes a weaker dollar because that's better for the conversion rates, it's better for the import export relationships. But with all these tariffs going on, the import export relationships are starting to change, specifically with China. And a lot of the other relationships are being negotiated now as there's a 10% baseline tariff across everything. So we'll see if this continues to fall. Actually, that would be positive for the market. But the official stance of the US government is they like a strong dollar. The unofficial stance of the US government is they like a weaker dollar. So thank you. I hope you found this helpful. I hope you're having a great weekend, and I will talk to you in the next video.